Well, the Nifty is as flat as can be, but a lot of stocks are moving around from the broader markets. And PB Fintech, that opened up well in the green after the company posted their Q2 numbers. The revenue has doubled, the losses have contracted as well in this quarter. My colleague Yash Jain caught up with the CEO and co-founder, Mr. Dahiya, as well as the CFO, Mr. Bansal, and began by asking them about the timeline for breaking even on the new initiatives of their business.
Cash break-even on the new initiative side of the business is a long term away, Yash. But the total burn on the new initiatives going forward will be under 200 crores a year. So I think the peak cost was in the Q4 of last year, when the new initiatives lost about 91 crores in the quarter, down to about 65 in the last quarter. And by the last quarter of this year, I think we should be down to about 30 to 35 crores. But there is no urgency in trying to break even on that business. So that business may not break even for the next couple of years. Okay. And, I think by 26, 27, my estimate is that business will be close to break even by 26, 27.
What is the understanding within the company, the target within the company in terms of turning adjusted EBITDA positive? By when do you see that happening? And also on the net profit side, by when do you have an estimation or a target of turning that positive?
So in Q4, we will be adjusted EBITDA positive. Once we turn adjusted EBITDA positive,
then become
next year is going to take care of my ESOP charges. And so next year profitable overall.
Okay, so then FY24 net profit, is that something that you're moving with?
Of course, I think we should be. We should be close to profit, or it may be whatever, right? So that should happen. Okay. But the interesting part, Yash, is we will be doing it with a 310 crore charge, which in 2 years' time is going to be 75 crores. So you have no change in our business. You have a guaranteed profit of about 250, 300 crores sitting there 2 years later.
One question to both of you, Yashish and Alok. First of all, before I get to the question, how much holding do you both individually have in the company at this point of time at the end of the quarter?
I have about 5.5%. And I think together we have, Alok, what, about 7.5% or so?
Yeah, near about 7.2, 7.3%, I would guess. And then there are ESOPs, which will get vested over time. Okay. So that will move it to about 9.5% out of whatever.
Do you want to sell any more stake in the company in the next 1.5 years? Or do you want to hold on to the existing stake and whatever the ESOP adds? And the same question after that to you, Alok.
I have sold what I had to sell.
Okay.
Okay, so I am done. I don't, that's basically it.
Okay. From you, Alok?
From Yash, I think we had explained it in the past also. The transaction that I had done was mostly to take care of the ESOP excise taxation and a little bit of some other expenses. But there is no plan in near future and even long-term future to part ways with any more equity.
Yashish, you spoke about the kind of confidence which you see in the future for the company, the financials, once these small disruptions go away. If you are so much confident about that and the stock price is favorable in that context, why don't you look at something like a buyback where investors also get confidence about the management intention, and you also, the company tends to benefit out of it?
We would like to, after April 24, turn the monies that we have to the shareholders. I see no reason for us.
In what form, Yashish?
You don't know that, right? That is exactly why I have asked Mandeep. I'm not technically qualified enough to know, and I don't think even Mandeep knows the answers yet. But yes, see, in the year, I would say, so nothing before April 24.
Okay.
But after April 24, I do not see what we will do with, let's say, 5,000 crores plus of cash on the books. We might want to keep 1,000 crores. I think we have at some point the ability to forever maybe return 1,000, 1,500 crores to the shareholders every year. Now, in what form, I don't know. I don't know the answer.
Right, so that's about PB Fintech, but let's take a look at Jubilant FoodWorks, among the topmost losers in the F&O space in today's trading session. And this, despite an inline second quarter numbers, Nigel, if you just take a look at their revenues as well as the EBITDA, it was no different from what the street was anticipating. Yes, the gross margins declined by about 200 basis points, but that was understandable because of the cheese and vegetable inflation, etc. The net profit on a reported basis was lower than street estimates, and that's because of a non-cash expenditure. Depreciation came in at around 112 odd crores versus 90 crores. And the effective tax rate was 26% versus 25%. The Domino's like-for-like growth, which is basically the new metric that the company is given as, again, same-store sales growth, had come in at 8.4%. They've added 76 new stores versus 50 to 60 that the street was expecting. And in the conference call, they said that they plan to add around 250 new Domino's stores in FY23 itself. The first half, they've done around 135 odd. For the non-Domino's business, Popeyes is the growth vertical, where they believe that this year they will open about 20 to 30 stores. But all the other businesses, which is Hong's and Ekdam Biryani, they are looking to, scale back right now to assess unit economics and only talk about all of this in the next financial year. And that is something that the street does not like. I'm looking at a couple of brokerage notes. ICICI Securities, for instance, has said that stagnant revenue per store, if you look at, the number of stores that have been expanded and over the last 3 years, the revenue, the way that has taken place, that is one of the concerns. And secondly, execution in new brands has actually utilized management bandwidth with subpar outcomes so far. Jeffries as well, they believe that the 3-year revenue CAGR for the company has been moderate 9%, and the entire benefit of price hikes that the company has taken has not translated into revenues because people have started to downtrade. So they've also trimmed their EPS estimates by about 3 to 4%. They've retained a hold rating with a target price of 580, and ICICI Securities has scaled their target price down from 750 around to 720 odd rupees. So the brokers are believing that, well, these numbers are okay in line, but the long-term trends do not indicate that, a lot of people are eating a lot more pizza. And why just pizza? The non-pizza business as well is taking a lot more management bandwidth than the results that it is giving.
Okay, all right. Mangalam, thanks for that. Well, on that note, though, we'll have to wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.